Today is October 20th, 2025. The digital asset landscape hums with a familiar, resurgent energy. After a period of consolidation and quiet building, market participants are once again looking toward the horizon. Anticipation is building for the next major wave of growth. At the center of the conversation are the two undisputed titans: Bitcoin-Ethereum split screen, Bitcoin left, Ethereum right, a shared trend line rising. Thousands of digital assets exist today, but these two command the lion's share of market capitalization, developer talent, and institutional attention. Their enduring rivalry defines each new cycle. 2025 is no different. Every investor asks, which giant will capture the narrative and lead the next bull run? It's not simply which asset is better, but which is better positioned for today's market dynamics. The drivers in 2025 differ from 2021 and 2017. Now we have regulated products like spot ETFs. Bitcoin's core strength lies in its elegantly simple and powerfully rigid monetary policy. With a hard-coded supply cap of 21 million coins, it stands as a bastion of predictable scarcity. The Bitcoin halving occurs approximately every 4 years and reduces the rate of new coin creation, reinforcing deflationary pressure. The most recent halving in 2024 cut the block reward, further constricting new supply. This issuance schedule underpins Bitcoin's digital gold narrative, attracting investors seeking a hedge against inflation and against geopolitical uncertainty. Its value isn't from transactional utility, but from credibility as a long-term store of value. Technically, Bitcoin prioritizes security and decentralization. Its dev philosophy is extreme caution. Changes to the core are rare, meticulously reviewed, and require overwhelming consensus. This slow pace ensures network stability and resistance to attack. Ethereum's monetary policy is a dynamic and fascinating contrast to Bitcoin's fixed supply. Following the pivotal merge in 2022, which transitioned the network from proof of work to proof of stake, the implementation of EIP 1559 fundamentally rewrote supply dynamics. EIP 1559 introduced a fee-burning mechanism. A portion of every fee is burned permanently removed from circulation. Lower issuance under proof of stake combined with burning creates a unique economic model. When network activity is high, ETH burned can exceed issuance, making it net deflationary. Scarcity is linked to network utility. The more people use it, the scarcer ETH gets. Ethereum's roadmap is continuous evolution. Ethereum's developers pursue scalability, efficiency, and greater functionality. When comparing network usage and on-chain activity, Ethereum presents a far more dynamic and multifaceted picture than Bitcoin. Bitcoin's on-chain data primarily reflects its role as a store of value and a settlement network for large transfers. Its transaction count is stable but limited by its block size and block time. In contrast, Ethereum's blockchain is a hive of constant activity. It processes millions of smart contract interactions daily. It consistently generates more in transaction fees than Bitcoin. In institutional adoption, the narrative is more nuanced. It's a simple, singular product, easy for traditional finance to package. After a detailed comparison of their technological, economic, social dynamics in 2025, it becomes clear that Bitcoin and Ethereum are poised to perform strongly, but for fundamentally different reasons. If the next wave of capital is driven by macroeconomic concerns, inflation, a flight to safety, then Bitcoin is positioned to lead. Conversely, if a technological catalyst drives adoption, then Ethereum is set to outperform. Most likely, they lead different phases of the same bull run: Bitcoin first, then rotation to Ethereum. For everyday investors, the prudent strategy is diversification. Hold both: a secure store of value and a high-growth technology platform.